Hi everyone, in this video we will continue to learn about ETFs, a common investment tool where many rich people park their investments. In the last video, I gave an overview of some of the advantages of investing into ETFs versus stocks and mutual funds. Although it was not an exhaustive comparison against a spectrum of different investment vehicles, I think I gave a high-level perspective on ETFs. Again, remember, I'm not a financial advisor. This is not a financial advice. We're just learning to gather different topics about finances and investments. In this video, I will discuss different ETFs by type of investment. We'll discuss differences between managed and unmanaged ETFs, and talk about some of the concrete examples of ETFs. We'll also look at the performance of some of the ETFs. And we'll talk about the tax benefits as well. All right, ETFs by investment type. So, equity ETFs. Let's start with that. They track a specific set of stocks or equities. These ETFs are most common ones. They provide investors with immediate diversification within a low-cost, easy tradable vehicle, allowing them to gain exposure to a basket of equities and diversify their portfolios in a cost-effective way. Equity ETFs represent the largest category of ETFs. They can target various sectors, industries, market caps, or investment styles such as growth or value. These ETFs offer investors exposure to a broad range of equities from large multinational corporations to small companies, and are an effective way to gain diversified exposure to the stock market. Examples include the Vanguard Total Stock Market ETF, VTI, or the Spider S&P 500 ETF Trust, SPY. Okay, next, let's take a look at crypto ETFs. Crypto ETFs offer exposure to cryptocurrencies like Bitcoin and Ethereum without the need to directly purchase and store these digital assets. These ETFs typically invest in cryptocurrency futures or related equities, providing a more regulated and accessible way for investors to gain exposure to the rapidly evolving cryptocurrency market. Examples include ProShares Bitcoin Strategy ETF, BITO, and the Grayscale Bitcoin Trust, GBTC. Okay, next, let's take a look at bond ETFs. Bond ETFs invest in fixed income securities and are designed to provide investors with exposure to different types of bonds, such as government, corporate, or municipal bonds. They can also target specific maturity ranges or credit qualities. Bond ETFs offer benefits like regular income diversification and typically lower risk compared to equity ETFs. Examples include the iShares Core US Aggregate Bond ETF, AGG, and the Vanguard Total Bond Market ETF, VND. Okay, next, commodity ETFs. Commodity ETFs provide exposure to physical commodities like gold, silver, oil, and agricultural goods. These ETFs can invest directly in physical commodities or in futures contracts. Commodity ETFs are used for hedging against inflation, diversifying a portfolio, or speculating on price movements of commodities. Examples include the Spider Gold Shares, GLD, and the United States Oil Fund, USO. Okay, next, real estate ETFs, REITs. Real estate ETFs invest primarily in real estate investment trusts, which own and often operate income-producing real estate. These ETFs provide exposure to the real estate market without the need to directly own property. They offer potential benefits like income through dividends and diversification away from traditional stocks and bonds. An example is Vanguard Real Estate ETF, VNQ. Thematic ETFs focus on specific themes or trends expected to drive growth in the future, such as clean energy, artificial intelligence, or electric vehicles. These ETFs invest in companies that are poised to benefit from these long-term trends. Thematic ETFs can provide target exposure to emerging markets and sectors, and are popular among investors seeking to capitalize on specific market opportunities. Examples include the Global X Robotics and Artificial Intelligence ETF, BOTS, and the iShares Global Clean Energy ETF, ICLN. ARK Invest has many thematic ETFs for space, AI, clean energy, etc. Let's take a look at actively managed ETFs. So there's a different categorization based on whether an ETF has an active management or is managed passively by tracking a particular index. So let's take a look at active managed ETFs first. Active managed ETFs are often overseen by portfolio managers who actively make investment decisions with the goal of outperforming a benchmark index or achieving a specific investment objective. Unlike passive ETFs, which simply track an index, actively managed ETFs involve frequent buying and selling of securities based on market analysis, economic forecasts, and fund managers' judgment. So the key characteristic of actively managed ETFs is active management. So portfolio managers use their exercise to select investments, time the market, or employ various strategies in an attempt to generate higher returns. Actively managed ETFs do have higher fee structure. Due to the active management, these ETFs typically employ managers that oversee the performance of the ETFs that require payment for their services, obviously, and that's why the fees are usually higher. They're more flexible. They offer flexibility because managers have the discretion to quickly adapt the portfolio in response to market changes or opportunities. And they have potential for higher returns. Their goals are often to outperform the market, but it comes with the risk of underperformance. Some of the examples are ARK Innovation ETF, ARKK, invests in companies that are leaders in disruptive innovation across sectors such as DNA technologies or energy storage. Or a PIMCO Active Bond ETF focuses on fixed income securities using active management to navigate the bond market. Okay, now let's take a look at passive ETFs. Passive or unmanaged ETFs, also known as the index ETFs, aim to replicate the performance of a specific benchmark index. They do this by holding a portfolio of assets that mirror the composition of the index, both in terms of the securities included and their weightings. They're usually tied to formulaic or algorithmic approach in terms of managing ETFs. So what are the key characteristics of this? Obviously, passive management automatically tracks the performance of an index without active decision making by fund managers. They have lower fees because it doesn't require a management team to oversee the performance and make the changes to the composition of the ETF. So, and that's why it results in lower operating expenses and lower expense ratio. It does offer more transparency. Holdings are usually a direct reflection of the index, making these ETFs highly transparent. And market performance. Returns are generally aligned with the index, meaning investors get market average returns, reducing the risk of significant underperformance. Common examples are Vanguard S&P 500 ETF, VOO, designed to track the S&P 500 index, providing exposure to 500 of the largest U.S. companies. iShares Russell 2000 ETF, IWM, tracks the Russell 2000 index, offering exposure to small caps, the U.S. stocks. So what are the other categories of ETFs? So there's a category known as semi-transparent or non-transparent ETFs. These categories involve a degree of opacity in the disclosure of ETFs holdings, allowing fund managers to make investment decisions without revealing the portfolio's exact composition. There's also inverse ETFs. They're designed to profit from a decline in the underlying market or index. They achieve these by using derivatives to short sell stocks, which means they gain when the market falls and lose when the market rises. Inverse ETFs are typically used for hedging purposes or to profit from market downturns. However, they're considered risky and are generally suitable for sophisticated investors. An example is ProShares Short S&P 500, SH. Leveraged ETFs. They aim to deliver multiples such as 2x or 3x of the daily performance of the index or assets they track. They use financial derivatives and debt to amplify the returns. While they can offer high returns in favorable market conditions, they also come with great risk and potential for significant losses, especially over longer periods. Leveraged ETFs are generally used for short-term trading strategies. Example is ProShares Ultra Pro QQQ or TQQQ. Buffered ETFs. These are designed to limit potential downside losses while allowing for some upside potential. They typically use options strategies to provide a buffer against a certain percentage of losses over a period of time, a specific period of time, in exchange for a cap on the maximum gain. Buffered ETFs reset their buffer and cap levels periodically and are suitable for investors seeking to reduce volatility and downside risk. Examples include Innovator S&P 500 Buffer ETF and Alliance IM US Large Cap Buffer 10 ETF. Let's spend a little bit more time looking at examples of buffered ETFs. I already mentioned these ones. SH, TQQQ, BNOV, ASBA, and there's a few others. Remember, these categories offer investors a wide range of options to align with their investment objectives and their risk tolerance. But the ones that are somewhat interesting to me specifically are buffered ETFs because they provide a level of protection. So let's take a look at maybe some of them. Recently, just a few weeks ago, Prudential launched 2 different buffer ETFs, US Large Cap Buffer 12 and Buffer 15. So if you can look at the Prudential news around this, so we go to Nasdaq.com. You can see here Prudential Asset Management Arm recently launched 2 buffer ETFs. So this is the news from January 3rd, 2024. So the launch of these 2 ETF series bodes well for Pru as it will contribute to its asset management fees about the future. Blah, blah, blah. So they describe a little bit, what it provides. So it will be providing exposure to ETF tracking S&P 500 index and have embedded 12 and 20% buffer options. In these ETFs, the upside will be limited to a predetermined level. Okay. Let's take a look a little bit more at the actual press release from Prudential. Prudential, $1.2 trillion global investment management firm, has launched 2 buffer ETF series. US Large Cap Buffer 12 ETF and 20. Let's see, ETF will be offered at 0.5 net expense ratio, making them the lowest cost 1-year target outcome buffer ETFs in the marketplace. Yeah, let's take a look at a little bit at the performance of these ETFs over the last few weeks. As you can see, like in here, we have Spider S&P 500 ETF Trust. So this is the benchmark index that they're trying to track, and their ETF. So when the index was down almost 7%, the ETF was down 0.9%. So it offered some of the protection here against the downturn, and when the index was up 2.5, almost 2.6%, the ETF was up 1.7%. So again, like this particular one is the Buffer 12 ETF. It protects from the losses up to first 12%. So here's the line here, and it caps the upside at 15%. Here's the line there. So it's a very good investment strategy. A lot of investors to minimize the volatility and the risks dump their investments or their money into this ETFs, protected ETFs, so to speak, and gain in that way. So like if you, for example, put your investments into like money market or a savings account right now with like 5% average annual return, this may have a potential to outperform that with 15% cap, but there is no guarantee against the losses as well. So it can still lose value, unlike savings account. All right, let's take a look at the tax advantages. How are the ETFs advantageous in terms of taxes? So ETFs often use in-kind transactions for rebalancing their portfolios. This process involves exchanging securities with institutional investors rather than selling them for cash. When an ETF needs to rebalance its holdings, along with changes in its benchmark index, for example, it can hand over the securities that have appreciated in value to an authorized participant in exchange for other securities or a basket of securities. So in a way, it's very similar to 1031 exchange in real estate, right? So because the securities technically are not being sold in these in-kind transactions, there is no capital gains. Therefore, this is one of the main benefits for parking your money in ETFs. The other one is lower capital gains distributions. So using in-kind transaction method again, ETFs typically distribute fewer capital gains to their shareholders compared to mutual funds. In mutual funds, when holdings are sold for cash to meet redemptions or rebalance the portfolio, any realized capital gains are passed onto the shareholders, leading to potential tax liabilities, even if the shareholders haven't sold their fund shares. So an ETF's ability to minimize its capital gains distributions helps investors avoid unexpected tax bills and can lead to greater tax efficiencies over time. So when do investors need to pay capital gain taxes when their money is in ETF fund? Well, so despite the tax advantages during the rebalancing, ETF investors are not entirely exempt from capital gain taxes. So when they sell ETF shares, they will still have to pay those taxes, especially when they sell for profit, or only when they sell for profit. The rate of taxation depends on how long the investor held the ETF shares, like short-term versus long-term capital gains, in their tax bracket. It's important to note that these taxes are only incurred upon the sale of the ETF shares and are not due to the internal rebalancing activities within the ETF itself. In a way, again, this is very similar to 1031 exchange for real estate transactions. If you sell your property directly on the market for profit, you'll pay capital gains. If you exchange it, you can defer the capital gains for later. The other time when investors may incur capital gain taxes or taxes rather, which is less common, but some ETFs may still distribute those, particularly if they cannot fully utilize in-kind transactions in funds that hold assets that are not easily transferable in kind. So additionally, the dividends received from ETF, whether reinvested or taken as cash, may also be subject to taxation, depending on the type of dividend, qualified or not qualified. Conclusion. So in conclusion, ETFs are a versatile and popular investment vehicle offering a range of benefits, including diversification, liquidity, and cost efficiency. They're available in various types such as equity, bond, commodity, real estate, crypto, thematic, inverse, leverage, buffer, etc., catering to a different investment strategies, goals, and risk tolerance. ETFs can utilize in-kind transactions during rebalancing to minimize capital gains distributions, enhancing their tax efficiencies. Investors in ETF should be aware that they will incur capital gain taxes upon selling their shares for profit and may owe taxes on dividend distributions. While ETFs offer several advantages, they also come with risks and considerations unique to their structure and assets they hold. It's important for investors to understand these aspects and consider their investment objectives, risk tolerance, and time horizon when investing in ETFs. So again, this information is for educational purposes only. It is not a financial advice. Investors should seek guidance from licensed financial advisors to understand the risks and benefits of investing in ETFs and to receive personalized advice tailored to their individual financial situation and investment goals. Thank you.